So there is signs that something is amiss within the banking system, whether it's the bear flag in the KRE or in these bigger banks. The selling that is going on is not mom and pop selling JP Morgan. I promise you that. They are going all in. So this tells me that there is some bigger players that are unloading the big banks here. There is no way that Powell would ever come out and say, yeah, there's actually some big issues in the banking system, sure, right? I mean, think about the fire that would spread and the market crash that would ensue if he said that. Having said that, what I do is I listen to the kind of the rumors out there, the rumor mill, and I mentioned this, like you just mentioned, is that I'm hearing a lot of chatter about the big banks unloading bad debt right now, trying to get ahead of some sort of crisis looming.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori. Thank you for joining us. The U.S. Federal Reserve has kept its key interest rate unchanged and signaled that just one cut is now expected before the end of the year. Fed Chair Jerome Powell said that inflation has eased over the past year, but does remain elevated. Meanwhile, U.S. consumer prices were flat in May. On a yearly basis, CPI increased 3.3% after rising 3.4% in April. Core CPI, which excludes volatile food and energy prices, was up 3.4% on a year-on-year basis. Now, that is still well above the Fed's 2% target, but it is also considerably below the peak of just over 9% seen nearly 2 years ago. Now, both the S&P 500 and the NASDAQ closed at new all-time highs on Wednesday following the Fed meeting. Let's get some analysis on the Fed, on inflation, the macroeconomy, and what this all means for gold, Bitcoin, and equities with a Kitco fan favorite, Gareth Soloway. Gareth is the Chief Market Strategist at verifiedinvesting.com. Gareth, always nice to see you. Welcome back.
Thank you so much. It's so great to be here.
All right. So, Gareth, let's start off with the Fed. We've got a lot to discuss, but let's get the big macro stuff out of the way. So, in a unanimous vote, Fed officials decided to keep the benchmark federal funds rate at 5.25% to 5.5% range. They now expect only one rate cut this year, and that's down from the 3 reductions forecast back in March. Let's take a listen to what Fed Chair Powell had to say.
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks.
All right. So give us a read, general thoughts. General overview from what we heard from Powell today.
Thought is, and these are a couple things that I picked up on just in these clips, but I listened to it earlier today, and there was a lot of uncertainty with Jerome Powell. He calmly talks about all of this, but the words that he uses is uncertainty, unsure about economics, about the economy, and as well as about how many interest rates are going to be needed to do cuts. So all of these things to me tell me the Fed is trying to land this plane smoothly, but they are acutely aware that there are many hurdles that they still have to go through. And remember, even with the CPI data coming in this morning better than expected, a lot of that was because gasoline and oil fell about 9% in May. And ultimately, we've already seen a 6% rise in oil just this month alone. And so again, you have to look at it and say the Fed still has inflation north of 3%. And they're now talking about cutting rates, but now it's only one cut. When does it go to no cuts? Maybe next year, even less cuts than they're saying as well.
All right, we'll talk about the dot plot for 2025, but let's focus on 2024. It did seem as though it was a perhaps less confident Powell that we heard from today. What is your read then? Is a September rate cut still on the table or still very much up in the air?
So the what I'm looking at here is now you have to look at the stock market, and the stock market continues to make new all-time highs. And I see literally zero chance that the Federal Reserve will cut rates until you see a significant pullback in the stock market. When we're talking significant, I would say it has to be at least 10%. So if we don't get a 10% pullback by year end, then you're not seeing the Federal Reserve cut this year. And again, look at it from this perspective: is the higher the stock market goes, the more inflation there will be in the system, or at least harder it is for the stock market to bring down inflation because of the wealth effect. Remember, everyone's looking at their 401ks, at least those that have investments. We know that the lower to middle income brackets are struggling. I mean, that is no change. We've known that now for months. The higher income, they have investments, and every day the stock market making new all-time highs makes them feel richer, and they go spend, and that creates a demand size movement where you're seeing more demand for goods, and that pushes inflation basically neutral to higher.
Right. And let's keep in mind that when we say 3.3%, that is the rate of more inflation year over year already, on top of, as I said, we had like 9% inflation 2 years ago, that rate of growth. So you certainly still feel this inflation every time you go and buy anything. You're saying the Fed is looking to the stock market to pull back before it can get inflation under control. But unless it signals that it's going to hike, the stock market still keeps on defying what's coming out of the Fed, higher, higher, and higher.
I think that's the amazing thing about it. It's like a catch-22, right? The Fed seems like they don't want to actually put the kibosh on the stock market and really force it down. But if they don't force it down, then you're going to see inflation stay north of 3%, and it's going to make it almost impossible for them to cut rates in the future. The other side of the coin, too, is that this Federal Reserve intervention, and this has gone on now for decades, has literally caused this massive divergence between the rich and the poor, right? If you're rich and you have money to invest, then if you have a drawdown in the economy and people lose jobs, the Fed lowers interest rates, allowing those people to borrow money. It pushes the stock market up even more. If the economy is strong, then they raise interest rates, and you talk literally about hundreds of billions of dollars in interest payments that are now being made to these high income individuals, making them richer, while the lower income are struggling to afford the inflation at McDonald's to feed their family. So again, this has been from the very start one of the worst scenarios. It all started, in my opinion, with the dual mandate. Once the Fed had to be concerned about employment plus the banking system, that's where honestly this began.
Right. And a lot of people are seeing the market as an inflation hedge, a store of value. You don't want to keep your money in cash because you're seeing inflation go up. So you put it in the market, and that makes it even harder for the Fed to then tame inflation and to take what action is needed there. Let's talk a little bit more specifically about the Fed's inflation projections, though. Updated its inflation forecast, raising the projection for core PCE to 2.8% from 2.6% in March. And they maintained their forecasts for economic growth at 2.1% and the unemployment rate at 4%, which hit this level in May. Markets seem to still think we're going to get the soft landing. If we look at how markets ended the day, new all-time highs for the S&P 500 and the NASDAQ. Can Powell pull off the soft landing? What says Gareth Soloway?
I see, you know me, I've always been a doubter. I've been a non-believer in the Fed. Historically, the Fed does not have an accurate, track record of engineering these soft landings. And really, if you look at it, it's they're in a hard place. I mean, I don't envy their position, even though it's somewhat self-made. But ultimately, I don't see how we get out of this without some sort of corrective move. And by the way, if they cause the stock market to come down, you're going to see a recession, right? That's going to cause businesses, Apple's, the Googles, all of these companies that still are already cutting jobs, they're going to have to cut more as consumers pull back. And I think one of the things to keep in mind for people is you have to look at the tea leaves, right? We've seen the latest earnings come out. We saw Starbucks, Disney, Expedia, traveling. A lot of these areas are starting to see the consumer pull back just a little bit. You still have the high-end consumer willing to spend, though, and they are keeping this economy on life support at this point and spending enough to keep the merry-go-round going. But if anything happens to that stock market, you will see the higher end start to pull back as well, and then recession follows very quickly. So no, I don't think the Fed engineers a soft landing here.
Okay, but do you see a cut in 2024?
I do. I actually do. I do think that we're on the verge at some point here in the next few months of some sort of bigger correction. There's rumors about the banking system going on there, whether or not that has teeth. We'll get into it in a little bit, I think. But ultimately, there are so many kind of issues out there, whether it's China, Taiwan, whether it's the banking system, whether it's the economy here, whether it's Ukraine, Russia. There's enough out there to create instability that I do think you'll get a big enough pullback in the market that the Fed will step off their seat and actually cut rates. But remember, historically, when the Fed cuts rates, that's actually when the market accelerates to the downside, not actually starts going up.
All right. Well, Gareth, our viewers like to call you Bareth, at least some of them. They're saying you're the perma bear. You're not alone, though. There is someone that is at least more pessimistic than you are, and that is one of the chief economists at the JP Morgan Chase. They continue to hold one of the most pessimistic views on Wall Street regarding the stock market. Analysts at JP Morgan forecast that the S&P 500, as tracked by the S&P 500 ETF Spider, SPY, will end the year at 4,200 points. So that implies about a 22% drop from current levels, down 22%. They raise a lot of the same issues that you just did in that note by JP Morgan Chief Market Strategist and co-head of global research, Marko Kolonovic. He reiterated his bearish view on equities, saying investors need to be underweight. He sees a high probability, a 50% probability of the macro picture deviating from the soft landing thesis, either because there is a near-term break in the U.S. economy or because persistent inflation induces the Fed and other major central banks to keep rates high for a prolonged time or to raise them further, thus raising fears of an eventual hard landing in 2025. And they also cite that, there's just too much optimism there, that they're dismissing risks like geopolitics, as you just mentioned, consumer behavior, elections. So he is saying a 22% drop from where we are for the S&P 500. Where does that line up with what you have in mind?
Yeah, so it's hard to know exactly, in terms of technicals, when by year end we will be. But again, I'm actually, if you talk about 2025 and going out into 2025, I think it's much more than that. I mean, we could be looking at 35% drawdown by mid 2025. And again, you named a bunch of the things, and I agree 100% that there are so many risks out there. And then even just the normal macro, the slowdown in the consumer, the stretched consumer who has $1.1 trillion in debt, and that's not even including phantom debt, which is like $700 billion on the backs of them. You throw in auto insurance, which has skyrocketed, home insurance has skyrocketed, the cost of money, the mortgage rates, and all of these things are just weighing investors down or consumers down. And that's not even to mention what it costs to now go out to a family restaurant like Applebee's or Chili's. So these are things that eventually you will get that straw that breaks the camel's back and cause a bigger corrective move. And right now, euphoria is in the markets. AI is the leading thing. But I would just point out that in every major bubble before every major collapse, there was always this same euphoria. And last thing I'll say to you, I was called Bareth back in 2007. I said, guys, there is something bad that is going to happen. Everyone laughed at me. And then we had 08, 09. I'm feeling the same way. The hairs on the back of my neck, Michelle, are standing up. Something is happening here. People need to be very careful.
Speaking of hair, I think you have a new haircut that our viewers may not be familiar with. Look, you brought up hair. I have to mention it. Now, I think we got rid of the man bun finally.
My summer due. It's summer due. I'm in Florida. It's hot out. You can't have long hair in Florida when it's this hot out.
I don't know. I think that can be seen as some kind of market indicator. Maybe that's some kind of market indicator there. But Gareth, yes, you were correct in 2007 being bearish. But we have had this conversation for a while, right? It seems like it makes sense that the fundamentals are there. We've got $35 trillion in debt. We've got the, inflation. We've got reckless spending. We've got all of the factors. We've talked about geopolitical risks. Russia, Ukraine, Middle East. I mean, just today we've got Russian warships heading to Cuba, right? It seems like all of the factors are there, and yet the market continues to defy expectations.
Yes,
so why? Why would it flip now? Because
Yeah, so
people who have been listening to you arguably have missed a lot of upside if they've been, shorting some of the broader markets
no
here.
doubt, no doubt they have. And in '07, listen, in '07, I was early. I was about 8 months early. I started warning in early '07. We didn't see the markets top out really until late '07, early '08. And there was upside I missed there. And this is the thing is, right, as a logical, technical trader, I see the things out there, but you have to also take into account, and this is something I still struggle with, is taking into account human emotion and the effect of FOMO. FOMO, people just wanting to chase even when the factors are not there. For instance, I look at the PE ratios amongst the large trillion-dollar companies. Historically, does it make sense that they're trading between 30 and 40 PEs? No, but ultimately, as long as investors are willing to chase gains like this, they can keep going higher in the short term until the music stops. And that will end up happening. But no doubt, I have been early in this scenario like I was in '07 into '08, but it will come, in my opinion, and it's not going to be pretty.
And last time we spoke, you thought that we would have a recession by fourth quarter of 2024. You still see that? A recession as in the technical definition of 2 quarters of negative GDP?
So I don't know if we'll get 2 quarters, full quarters in the books. That might be early, the first report in early 2025. But I think all of us, and listen, I want to be clear on this. I would say there's a good 40 to 50% of the population in the US that already feels like they're in a recession. But in terms of the data and the analysts and the economists calling it a recession, I think that probably takes place in early 2025.
Right. And, there is a disconnect between what people are feeling, what the data is saying, and it's not just feelings. It's a very real sense when you're at the grocery store and, paying for a bag of groceries that's arguably gone up 20% over the last 2 years, even though we're told, 3.4% year over year. The data doesn't really seem to add up. Let's talk about what we're seeing in terms of quantitative tightening, because we did get some insight in what we're expecting from the Fed to do with its balance sheet. Because while we're talking again about keeping, rates higher, the Fed did say that it would continue to reduce its balance sheet, but at a slower pace. So reducing its holdings of Treasury securities by up to $25 billion a month. That's down from $60 billion a month. That's quite significant, Gareth. So the cap for mortgage-backed securities remains at $35 billion. So slowing down quantitative tightening, doesn't that negate some efforts on inflation?
Yes, it's the beginnings, right? It's the step just before the Federal Reserve cut rates. So they're obviously seeing something, right? They're seeing something in the data that they're not sharing with us that is making them slow down. And this is another pet peeve of mine, that every crisis, their balance sheet, the Federal Reserve's balance sheet, balloons by 100 to 150%. And then during the good times, quote unquote, they reduce it by 15%. And just to give people an idea, they ran the balance sheet up during COVID to 9 trillion and change, and they've gotten it back down to 7.5 trillion. Prior to that period, it was probably $4 to $5 trillion. So you look at that and you just see the longer term impacts of what's going on. And people like to say the Fed is independent, their debt doesn't matter. It is still debt, folks. You and I in the US, we are responsible for that. You might as well add to the US deficit, the debt in the US, and add it up there as well. But you're right. When you're talking about the rundown, the slowdown of their runoff, it is a way of them actually cutting rates without taking that step to cut rates.
Right. Injecting liquidity into the economy, into the system, which then arguably, negates the efforts on inflation. But back to this, JP Morgan call, right? Do you see 22% down from where we are now, at ending the year down 22%? Like that dramatic?
I do. And I want to be clear on this. If we go to my chart here, we can talk some levels. So this is the S&P 500 chart right in front of us here. And what we have is a couple trend lines that I'm monitoring. This first trend line takes from the COVID lows to the panic March 2020 lows, and it goes to the recent highs, and we just tagged that today. Now, whether or not that's a top, we don't know yet. We don't know until after the fact when we look back on it. If we do go higher, there's an incredible trend line here that goes back to the 2009 lows that connects through the 2021 highs, and that's just a little bit higher at around 55 to 5,600. My guess is the top is very close, if not at hand. Now, in terms of a drawdown, where are we looking? Well, All you have to do is basically connect major recent lows, and we can do that and then do a measured move here. So what we do is we'll just draw this through these two lows. And what we get here, and this is probably a good chance for a year-end calculation, is we take the current levels, we draw a line right back down here. And to me, that's looking like about an 18% correction on the S&P, potentially by year end. Now, this doesn't take into account if we really slip into a recession that gets bad in 2025, then you could be talking about much, much lower levels. But I think by year end, 18% retesting that major trend line would be very, very likely.
But then, Gareth, if we start to see this slip in the markets, right, isn't that the cue for the Fed to start cutting rates, which could then trigger the same sort of optimism in the markets that we have seen in the past? Wouldn't that then get the markets to rally again, right, at the sign of the first cut?
So this is the key, is that initially people will get excited about the cuts. And then what you see historically, and if we look at the data from past scenarios where they've started to cut, what actually ends up happening is that the investing public begins to worry that the Federal Reserve is going too slow, and they're starting to panic. And this is the wave of emotion from massive greed that we've been seeing to go all the way towards the fear side. So when the Fed starts cutting rates, historically markets actually that's when we start to see selling, because they start to be concerned the Fed is not moving fast enough to avoid a major drop like 08, 09. So in theory, if you look at the data again, it's when they cut rates that the market actually starts to sell off dramatically.
Okay. What would trigger this? What all of a sudden changes, happens? What kind of event sets this narrative into this downward spiral?
So I think the most, we all think about the Black Swan events, the what if China invades Taiwan? What if the war in Russia in Ukraine gets bigger and envelops more countries? But in reality, it's probably the U.S. economy. And with the slowdown in consumer spending, we've all been told for decades that the consumer is the backbone of the U.S. economy. If we start to see selling or a slowdown in that consumer, and the consumer stops buying, that's where you see the PE ratios that some of these companies are trading at. Like, think about how much impact. You now have 6 companies, right? Microsoft, Apple, Nvidia, the trillion-dollar names. They literally make up over 30% of the S&P 500. 494 companies are less than 70% of the S&P 500 now. And so if you get a slowdown and you have these mega caps trading at 30 to 40 forward PE ratios, and they go back to even just a general norm of historic PE ratios, let's say 20, you're talking about 40% downside in those stocks, which will easily crush the stock market down at least that amount as well. So really, again, there is the most likely scenario is that you get a slowdown in the US consumer, and then that's what takes the markets down.
All right, I want to bring in the other central banks that we heard from earlier this week, because we did get cuts from the ECB as well as the Bank of Canada. Does it seem as though the Fed can maintain this position if more and more central banks around the world start to cut?
So they can for a certain amount of time, but there's no doubt that if we start seeing more and more cuts from these central banks, the Fed will have to do something. In fact, they'll be forced into it. Now, the bigger question will be is, where is inflation at that point? Is it coming down enough? And the Fed may fight that. The Fed may stay the course as long as they can until you see the stock market forcing their hand to cut these rates to more normalized levels compared to other countries. And just one more little tidbit that I'd just like to throw in there. I didn't mention this as a black swan / risk for the markets, but the dollar yen is a major risk for the overall economy and the U.S. here. Remember that the Japanese central bank intervened just about a month ago to push their currency back up against the U.S. dollar. We've now started to see the Japanese yen starting to weaken again. And the way that the Japanese central bank that basically strengthens their economy or their currency is by selling U.S. bonds. Remember, they're the biggest holder of U.S. bonds. And so if you start getting a lot of U.S. bonds being dumped on the market, and there's a lot of talk that China's already doing this, they're dumping U.S. debt to buy gold. And we've seen the gold numbers go crazy over there. You actually have a scenario where the Fed may be unable to really lower real interest rates significantly if it gets to that level. So again, not something that's likely, but it needs to be on an investor's radar.
Right, we'll get into gold. China has been on a gold buying spree. They did pause the last month, but it was 18 months of solid purchases before then, and most likely will continue. We talk about the economy, and we have to take in the banking sector, obviously commercial real estate and banks, because one of the narratives was that something is going to break. You can't have rates at 20-year highs for this long without there being a crack. So far, we had that March crisis in 2023, which you did actually flag correctly. But so far since then, the banking system seems to be weathering things. We did have that come up in today's presser, and Powell said that the banking system has been solid and strong. Let's take a listen.
In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Is it in good shape, Gareth? I mean, you have mentioned that the regional banking ETF has been forming a bear flag pattern since the crisis lows of April of last year. So break that down for us. Tell us what that suggests.
So I think the first thing to take away from this is that there is no way that Powell would ever come out and say, yeah, there's actually some big issues in the banking system, sure, right? I mean, think about the fire that would spread and the market crash that would ensue if he said that. Having said that, what I do is I listen to the kind of the rumors out there, the rumor mill, and I mentioned this, like you just mentioned, is that I'm hearing a lot of chatter about the big banks unloading bad debt right now, trying to get ahead of some sort of crisis looming. And when you talk about mortgage-backed securities, remember, a lot of these securities were bundled into these kind of vehicles at interest rates that were so low for the last X amount of years. Well, now, because interest rates are so high, the amount of losses in these mortgage-backed securities are things that are potentially rivaling what we saw in 08, 09. In addition, the commercial real estate market is in tatters. And these are all things that banks are holding on their balance sheets. Now, we're not necessarily talking about the JPMs. The JP Morgans are definitely on the stronger side. They probably will be okay. But you're right. The KRE is not looking good. In fact, let's take a look at that KRE right now for people and just look at this chart setup. So in technical analysis, there's basically what's called a bear flag. Here was the crisis last year in May of 2023, the drop. And look at how you have not seen a recovery in this. And if we do a little parallel, this again is the flagpole and the bear flag formation. And historically, this is a chart pattern. If you looked at 100 of these or 1,000 of these, about 7 out of 10 or 770 out of 100 would break to the downside. The other thing to keep an eye on here is I was looking at, once I heard these rumors, I looked at charts like JP Morgan. Look at this trend line breakdown that just started on JP Morgan. So we are seeing a breakdown in some of these bigger banks. Citigroup has already broken down. Look at this trend line right here. And so there is signs that something is amiss within the banking system, whether it's the bear flag in the KRE or in these bigger banks. The selling that is going on is not mom and pop selling JP Morgan. I promise you that. They are going all in. So this tells me that there is some bigger players that are unloading the big banks here.
When you say bigger players, who do you have in mind?
So we're talking institutions like the in-the-know institutions, the hedge funds that are in the know. These are the bigger players that are looking for exit liquidity. Like, for instance, today on Apple, crazy move up on Apple yesterday, and today gained something like $300 to $500 billion in 2 days. And then late in the day today, it got smoked down. Apple dropped about $7 per share in the last hour of the day. That was exit liquidity, big money, dumping it into retail investors that were chasing this to the upside.
We'll get into Apple a little bit further. So in terms of this banking situation, you're saying that big institutional players are starting to have concern about the banking sector and they are selling out their positions, even in the big banks like JP Morgan?
Yeah, I think so. Because listen, when investors start to get word of this, they don't say, oh, well, that's JPM, let me not sell. In general, it's ask questions later. So you will see selling in these. And listen, JP Morgan's going to have exposure. They can limit their exposure, but it's still going to take a hit. It'll hit their bottom line. And so I think that's key. And if you talk about Marko Kolanovic and his comments about it, he's with JP Morgan. if he's calling for this, like, you'd have to say to yourself, he might know something. He might just not be able to say something about what is going on or what he foresees. He has to kind of toe the line there because he's with the bank. But I do think that he's seeing something there as well.
All right, let's take it back then to the stock market. And obviously the rally has been a very narrow rally. We had a handful of stocks really propping up the markets. We touched on Apple. Talk us through what we saw there, because we did see Apple reclaim its title of the world's most valuable company from Microsoft during Wednesday's trading session. And two of Wall Street's favorite words, artificial intelligence, helped it get that way. Apple's current market cap is around, $3.369 trillion. And this whole Apple story began on Monday at their Worldwide Developers Conference when Apple unveiled its AI strategy. And, Wall Street loves AI these days. So walk us through what we're seeing in Apple.
Yeah. So first of all, this shows the insanity in the markets, right? So you have this big conference where Apple unveils their strategy for AI, which is basically plugging in ChatGPT into their systems and letting ChatGPT do its thing. By the way, every other phone maker is going to do the same thing. The stock on that day sold off on this news. And then all of a sudden, the narrative in the overnight started to change, where all these talking heads, these analysts came out and started saying, oh, well, this is actually really good. This is great. And before you knew it, you got all the retail investors to pile into this thing and shoot it up incredibly. In fact, I haven't seen the size of this green candle here in my recent career on Apple in one single day. Today, it did it again. And then finally, like I said, we saw this exit liquidity created. And towards the end of the day, Apple got slammed down. But look at where it got slammed down to. This was incredible. We had a pivot high from August of 2022 to this pivot high here in July of 2023. Price literally goes up, kisses that level, and then dumps out. So again, insanity in the market. As much as it is insane to me that Nvidia has gone up as much as it has in such a short time, this shows the animal spirits and the greed of investors willing to pay any valuation for stocks and not thinking about, what if the consumer stops buying? What if we do see a recession? And that's what I'm scared about, folks. That is absolutely on my radar.
So then what's your call on Apple right now?
I would not be surprised if today. Yeah, I would not be surprised if today put in a top. The amount of volume, what you look for as a technician is you look for price reversal after a major move, and you look for major volume, and you look for a trend line hit. The volume yesterday and today was unparalleled. I think you have to go back years to find a day when volume was as high as it was today on Apple. We hit the level and we saw the late day reversal, which is institutional distribution. Those things most likely signal a top, or at least close to a top in Apple. And I think, again, the torch was Nvidia was the hot play. Now the AI people could say, hey, listen, let's run Apple. Maybe the next one's Google for all I know. But they're basically taking the small money and pushing it into the next one, creating extra liquidity. And people will be left holding the bag, just like with GameStop recently.
Right. Now, Gareth, the reason makes sense, but the sentiment and reason and fundamentals have not been in alignment here. You were expecting a top for Nvidia. We haven't seen that. In fact, we had the stock split recently, the 10-for-1 stock split. Nvidia still seems to be unstoppable, because of the stock split, even more so. So give us the breakdown there.
Yeah, so you're right. Nvidia it's an incredible mover here, guys. The animal spirits, the AI narrative, even after hours, we saw Broadcom report earnings. That stock's up almost 15% on AI stuff as well. It seems like if you have AI in your title, it's just like internet back in the .com era. And I still, by the way, it ages me a little bit, but back in 99, literally companies would change their name to add a .com at the end, and their stock would go up 1,000% on the back of that in a few trading days. And so it's the same sort of momentum. Internet was the thing back then. AI is the new thing. It's great. It's amazing in terms of the multiple expansion that we're seeing in the markets, but there will be a reckoning day where margins come back to roost like it did for Cisco. And let's not forget, Cisco has never seen the levels it saw in 1999 and 2000 since that point, ever since then, because basically the internet became a commodity, right? And that's what AI chips will do, which eventually, or prior, semiconductor chips were like that.
But correct me if I'm wrong, Gareth, there was a time where you were like, Nvidia has to reverse at this point, right?
Oh,
And look, you could say...
I thought Nvidia was ridiculously priced when it was, 25, 30% lower, even more than that. I thought so. And I was dead wrong on that. Let's be clear on that. The momentum, I think I underestimated the momentum and how much money is still left was left on the sidelines of investors. I don't know if it's more leverage. I don't know if it's everyone piling into just a few names. But I think that is something to keep in mind, is that because you have such a few amount of stocks running the S&P and the NASDAQ, everyone's just piling into this set few names.
You have suggested that because of this, there could be room at the time for small stocks to catch up here, right? What's the Russell looking like?
Yeah, so the Russell is not looking quite as good. So it did have a move up after we talked about that. In fact, a decent little move up here. I still think there's a chance that you could play pickup. We did see the Russell performing well with interest rates going down. And that's really what the Russell is all about. It's 2,000 stocks. So it's the best gauge of overall market kind of strength, because it's so many stocks in this player without the $1 trillion names. It also feeds the most off of low interest rates, because these are the companies that are smaller. They have to borrow money. So if interest rates come down and continue to come down, the Russell should outperform. But my biggest fear is that interest rates are not now going to be able to come down enough for these companies to really outperform enough. And if the economy weakens and the borrowing costs remain relatively high, then things in the Russell are not going to do well. So at this point, I'm more skeptical. I'm actually worried that the same sort of chart that we saw in the KRE is kind of here. And what I mean by that is you can kind of see the same sort of pattern here, the flagpole and the inside bar action here. And if we flip back to the KRE here, you can see that same sort of price action. Let me get rid of that same sort of down move and sideways chop. So I am a little bit more skeptical now on the Russell. I do worry that the time has now passed for the run to occur, and I do worry that it could start to see some downside.
And look, arguably, if these cracks in the economy start to manifest, that ultimately brings the S&P 500 down about 20%. I mean, surely the small stocks would get hit far worse, right?
Especially if rates are not able to go as low as people hope, right? So I do worry that the days of 1%, 2%, 3% interest rates are long gone. I think, again, 3+ is probably the new norm. And that does put a problem issue for a lot of these companies that got used to borrowing money for so low. And now in the future, even in a weak economy, they may not be able to do so. And it might make it hard for some of them to survive.
All right. So, Gareth, last time we caught up was on the day that both gold and Bitcoin, the day of the week that both gold and Bitcoin hit all-time highs in mid-March. At the time, you expected Bitcoin to pull back and to hit 49 to 50K by the end of May. That didn't happen. So What went wrong with the thesis there?
Yeah, so I think what went wrong is just the risk on narrative, right? So as long as the stock market continues to make all-time highs, it's going to make it almost impossible for Bitcoin to have any sort of meaningful major pullback, because as long as risk is all about people want to take risk, Bitcoin is one of the main places to do that, right? So the one thing I will say is it still hasn't made a new all-time high since we last talked. We talked when it was around 73.5 to 73.9. And since then, we had a drawdown back to about, in all fairness, it got to about 56,500. But you're right, it didn't get back to the 50,000 level like I was expecting. I will say this, I still think it's going there. It still may make a new all-time high first, but as soon as we see the weakness in the stock market and multiple sell days, sell weeks in the stock market, I do think Bitcoin comes down. You can see I have the chart all annotated out here. We have this trend line here, which is parallel. We got above the parallel and we're consolidating. If you break back into this parallel down here, price is likely going to sell off. And look at where this trend line is, right down around 50,000. So I still think it's going there, but it just may take a little bit more time at this point. But again, it's all up to the stock market. And really by default, it's up to the Federal Reserve, right? If the Fed's going to play hardball with the markets, they will sell off. If the Fed caters to the markets, they may not sell off in the near term.
So you're saying that the correlation is going to be stronger than ever between Bitcoin and the markets. The minute the markets start to have a broader sell-off, Bitcoin accelerates downwards with it.
Yes, absolutely. Absolutely. In fact, you see that quite often. In fact, Bitcoin's been selling a little bit even when the markets haven't been selling as much. But it seems like anytime there's weakness in the stock market, any sort of uptick in fear, Bitcoin starts to come in, which makes a lot of sense since, again, it still is a risk asset. And the bigger question is when do we get that bigger correction? It may not come for months, but at some point that stock market is going to take a 10% tumble. And I think all the Bitcoin chart needs is a 10% tumble in the stock market, and it'll easily see 50,000.
Do you see 50,000 before another all-time high?
That's a tough one. We're so close. I mean, we are literally 6,000 away from an all-time high right now. To be honest, I don't know. And I'll just be honest with you guys. I wish I could give you a one way or other. I will just say this, that again, if the stock market tops out, then I don't think Bitcoin sees a new high until we see a bigger flush out in the stock market and the stock market starts to recover.
Now, of course, timing is everything, Gareth. Being early is like being wrong, right? When it comes to the stock markets. Right. We were just at consensus. Obviously, the sentiment there was very, very bullish on Bitcoin. We had some guests saying 100,000 by the end of 2024, 125,000 by the end of 2024. Where are you with that estimate?
I think you will see 100,000 by the end of 2025 on Bitcoin. So I am a mid to long term bull.
Okay.
Yeah. So I don't think it happens this year. I honestly don't. I think again, there's too many obstacles that are going to be involved to get us to 100,000. But I do think sometime in mid to late 2025, you will see Bitcoin take on more and more of that safety trade as the U.S. deficit debt goes higher and higher. People are going to naturally gravitate towards things like Bitcoin and like gold. And I think both those assets are ultimately over the next 12, 18, 24 months going to go a lot higher.
Right. And that's your perma-bear thesis, right? Because you see the fundamentals, you see the issues, and that's what ultimately makes you bullish on Bitcoin and on gold.
And I'll just say this too, is I think honestly, if you don't see like you can say that, oh, it's not going to happen now, but I think there's no one out there that can look at what the state of our economic system is, with what the government is doing, what the government is going through, what personal issues people have with their debts and the inflation. There's no way that there's not a reckoning day at some point. The question is, when is that point?
Yeah, well, timing is everything. But yes, that reckoning day is going to approach. A lot of our guests say, when these things happen, it's slowly, then suddenly, right? It builds up, and then when it hits, it just hits. And that's your bullish case for Bitcoin, but you're still saying Bitcoin not hitting 100,000 before 2025.
Yeah, I think it'll be 100,000 by 2025. And you're dead right about that, where initially the selling starts slowly. Like if you look at 08, 09, it was slow, lots of bounces. And then in early 09, just before it bottomed in those final 3 months of January, February, March of 09, it was all out panic and just straight down. And that's how markets bottom. And I think, again, when the stock market really collapses, it takes Bitcoin down with it. But like we saw when COVID hit and it was March of 2020, gold dumped very quickly and then recovered very quickly. And that's kind of what I'm thinking will happen with Bitcoin as well.
All right, let's talk about gold because you have been correct on your gold calls every single time, I believe. Up, 12.7% year to date at around, 2,334 today. What's your read? How is gold responding to what we heard from the Fed? What do you expect?
Yeah, so gold today had a relatively weak day. Considering the drop in the dollar, it was on the weaker side. It only eked out a small gain. I do want to show you something that I think is so cool. So if we take a look at this longer term chart of gold and what we do here, so we're going back to the 1980 high of gold. And then if we connect it to the high of 2011, look at where this trend line goes. This is one of the coolest things about charting, is that if you take this line, you literally come right up to this level, right? So now that I zoom in, look, we've pierced this level, but we're struggling here on gold. So you have to respect that trend line. Again, a trend line that goes back 40 plus years to 1980 is a powerful trend line. Now, having said that, What that tells me is in the near term, I still think there's a little bit more downside in gold. I could see us coming back to about the 2200 area, give or take, maybe even a little bit lower. But I do think eventually on the next leg up, we take this area out. And I do have an upside target. End of year was 2500. That was my target when we started January. I think by 2025, the first half, we're probably at 2800 on gold at that point.
2,800 by the second quarter of 2025?
Yeah, that's correct. Yep.
And what gets us there? Just momentum building? What gets us there?
Yeah. So unfortunately, more of the same. I think the U.S., to me, it doesn't matter what president is in the White House. I think once a president is in the White House, they tend to just want to make sure everything makes them look really good, which is generally spending money. We haven't seen any of our politicians have a backbone in stopping the spending generally again. So for me, it's that deficit, which now interest payments are now north of $1 trillion alone. With higher interest rates for longer, those interest payments are only going to go higher because we have to refinance our debt as it comes due. And then as you see all of that going, if you see the Federal Reserve having to come to the rescue again in a downturn in the economy and basically building their balance sheet higher and lowering rates and making money free again, it all has the impact of making gold more valuable in terms of US dollars. And I think you throw in any of the insecurities of Taiwan, China, all these other things, that just is extra fuel on the fire of gold. And I do think physical assets are going to be a place to be along with Bitcoin.
Yeah, certainly no shortage of geopolitical flashpoints these days. Very quickly, let's get your thoughts on silver. Silver's been flirting with $30, closed a bit low after we heard from the Fed. But what are your thoughts there? It has had a good run up about 23% for the year.
Yeah, absolutely. It's been a great run thus far. I do think silver has a pullback. One area, so I'm looking to accumulate myself. I haven't had any silver positions recently since this move to the upside, but I have a couple levels. One is going to be around the 2850 level. I get that level on a technical basis by connecting these lows right here. So we're getting close to that first add level where I'm going to start to accumulate. And then the big level is going to be right here, folks. And if we look at this, right, and we look at this trend line here, we take the high and we stretch this to this high through this high. And this is what we call a retrace to the scene of the crime. It's back at around $25.50. That would be where I load a majority of my stake in silver should it get there. Now, remember, there's always a chance I miss the trade, but the greatest thing about being a trader where you trade crypto, stocks, and commodities, there's always another trade around the corner. So I've missed many trades in my life. I'll miss many more. I just need to catch a few. And if it comes back there, that's silver for me.
Right. And of course, you are a day trader, you're a swing trader, right? So I make you give me these long-term forecasts and hold your feet to the fire. And I will give you credit because you come up with very specific answers instead of dodging them. But for the most part, in terms of your own trading activity, it's a daily moves kind of activity, correct?
That's right. I mean, to be honest, the only way I can hold something long-term is when I for instance, I buy some physical gold and silver, and because it's such a pain in the butt to sell it once you have it as physical, it makes me hold it as a long-term investment. But otherwise, I can't help it. Like if something goes up 30 or 40% and I see a chart that's going to pull back, it's like, well, why wouldn't you sell it and then just buy it back cheaper? So by the blood in me, I'm a shorter-term investor. There's no doubt.
But still bullish on gold and Bitcoin long-term picture. Give us your final thoughts as we wrap up here, Gareth. What is your point of strongest conviction these days?
So the biggest things to me, we've seen some of the most incredible runs in some of these mega caps, and the mega caps have led this market. If they start to falter, let's say today was a top on Apple, let's look at Nvidia, let's look at Microsoft. If they start to falter, this market is in a lot of trouble. The other thing to watch is the bank stocks. Keep an eye on the bank stocks, the KRE. Does it start to break lower? Is there some sort of fire there that we're not being alerted to yet that the banks know about? And then ultimately, I would continue to look outside of the US for investments. China still looks attractive, although very minimally because of the risks of China-Taiwan. But the valuations in some of those stocks make our stocks look ridiculously expensive. I still like Brazil. I still like some other emerging markets. And I think, again, just look at the physical metals, things that will defy when the US has to print another $10 trillion. Things like that should do very well over the next 6, 12, 18, 24 months and even longer.
All right, Gareth, always a pleasure chatting with you, catching up with you. Thank you so much for your insights.
Thank you so much, Michelle. So nice to talk to you. Thank you.
We'll see you again soon. Gareth Soloway, thank you. And I do want to say a special thanks to our sponsor, Swan Bitcoin. Just a reminder to our viewers that Swan does have an IRA product, which allows you to invest directly in Bitcoin with your IRA. There's a way to set it up that you're basically buying Bitcoin on autopilot that allows you to take advantage of dollar cost averaging as you accumulate Bitcoin into your IRA. And with the prices, that's always a good way to do it. There's a link in the description of this video with a special offer for Kitco viewers to help facilitate that process. So do check that out. And as always, thank you for checking out this video. If you're watching us on YouTube, make sure to subscribe. And please leave your comments. We'd like to hear from you. Feel free to praise, wide, or just opine. We do read your comments and we do take them into consideration. For me, Michelle Makori, and the rest of the Kitco team, we'll see you again soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. Traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/retire.